Advanced Financial Modeling, Topic 11, Cost of Capital and Real Options, Learning Objective number 4. We're going to compute WACC and use for stock valuations. So summarizing what we've collected so far for Walmart data, we have Walmart has an unlevered industry beta of 0.5150. That's because they're half a grocery store and half a retail store. Their DDE ratio is 0.19 because they have $66 billion in net debt and $340 billion of market value of equity. And we're able to calculate a levered beta that we'll use in CAPM of 0.615. And that is their unlevered beta times their DDE times 1 plus their DDE ratio. So 0.515 times 1 plus that 0.19. We then can plug that levered beta into the CAPM formula, risk-free rate, plus their beta times market risk premium, and get a Walmart CAPM KE. So let's go ahead and do that in the spreadsheet. We first will calculate the levered beta that we'll use for CAPM, and that is the unlevered beta times 1 plus their DDE ratio. I can then use that in my CAPM formula, risk-free rate plus the levered beta times market risk premium. That's roughly the 100-year average of the expected or historical returns of the stock market over the 10-year treasury. And now I can calculate the weighted average cost of capital. I already estimated that my cost of debt is 3.87. That's the average rate of return on the bonds of AA rated firms. And I got a tax rate for Walmart of 25% from their most recent income statement. And here I've calculated the E percent, which is E over D plus E, and 1 minus that is their debt percent. So I can calculate WACC for Walmart. It's their equity percent times their CAPM cost of equity plus their debt percent times their cost of debt times 1 minus the tax rate, because so you get a tax break by when you pay interest. And then we have the the weighted average cost of capital for Walmart, 519. All right, just want to point out something because it's very confusing. Be careful, DDE ratio versus D percent ratio. So when you see D percent versus D over E, well, D percent is D over D plus E, so don't get them confused. Be very careful. So how could I use this number? Well, you can think about this interpretation. When Walmart acquires for money from their debt and equity holders, roughly getting 83% on average from equity holders and 16% from debt holders, their cost of getting funds is 5.19%. So their projects, to say open another store in another city, should return at least 5.19%. Otherwise, they're destroying value. They're not even raising it, or the project's not giving enough return to satisfy the capital providers. We also are going to use that WACC to value a stock. Recall that you can value stocks by discounting free cash flows. Well, the appropriate discount rate to value free cash flows is WACC. And if the stock valuation using WACC as the discount rate is greater than the market price, then the shareholders are getting a return greater than the required return for the stock, so you'd buy it. So that's why we use WACC to discount unlevered free cash flows. So on an earlier topic, I valued Walmart taking the present value of free cash flows, and I just used a guess of 6% as the discount rate. I will replace that with 5.19, which is our WACC. And when I take the present value of FCFFs estimated earlier, discounted at 5.19, and then subtracting out, and that's the enterprise value, I subtract out net debt and divide by number of shares, I can now value Walmart at $200 a share at that point. And the last thing I want to do before we move is I want to give you a new perspective on NPV and IRR. Remember, a project NPV is the value created from the project's cash flows. The IRR is the rate of return. So I'm going to suggest to you is that in most cases, the NPV discount rate and the IRR minimum hurdle rate, that minimum rate of return you have to get for a project, is the project cost of capital. It's the project's WACC. That's what we're going to use for the NPV discount rate and the IRR hurdle rate. Now, given that the discount rate is the WACC in NPV, you can now understand what NPV equals 0 even means and why you'd still do the project. So here's a project with a 10% cost of capital. All right, so we'll say that we estimated the WACC for this company to be 10%. That's their WACC. And say that you estimated the cash flows of a particular project is you're going to spend $100 today and you're going to get $110 next year. Those are the free cash flows of a new project. You go ahead and calculate the IRR of that project. It seems pretty obvious. It's a 10% rate of return. You spend 100, you get 110 next year. Now, if we take the NPV of that project using the WACC of 10%, you get 0. So here's the interpretation. It cost me 10% to raise this $100, right? I want to open up a new store and I need to get $100 from debt and equity holders. On average, it's going to cost me 10% or require 10%. I have just enough. If this project gives me 110, I have just enough to pay off the shareholders and the bondholders. So that's a 0 NPV project. I have just enough money to satisfy or to give the money back to shareholders and bondholders. Now, what if the project had cash flows of this, $100, but you estimate the free cash flows next year are going to be 120? You can easily see that the IRR is 20%. And if you calculate the NPV at 10% discount rate, you get 9.09 as the NPV of the project. Let's think about that. When I got the funds, I need to pay these people back $10, $110, because the cost of capital is 10%. But this project's actually returning 120. So I have an extra $10 next year. So that extra $10 discounted at 10% is 9.09. So I'm creating value. I have more than enough money to pay off both the bondholders and the shareholders. But the bondholders, they have fixed interest rates, or the debt holders have fixed interest rates. So all that extra value, that extra $10 next year, discounted at 10%, which is $9, is going to accrue to the shareholders. It's going to make them richer. So the game or the mission in finding projects is to find projects that have a rate of return greater than your cost of capital, which means you get an NPV greater than 0. You have more than enough money to pay off the debt holders and shareholders based on the risk of the firm. In the next topic, we're going to compute WACC used for project NPVs or IRR hurdle rates. So we're going to explore that concept more fully.